time is the friend of the wonderful business and enemy of the mediocre.
Some of the consumer companies have never made it to a portfolio because the valuations have been very, very high.
Liquidity is paramount when you are investing in debt securities in an equity fund.
What would be a mutual fund scheme that we would be excited to put our money in and that we would confidently be able to recommend to our family and friends?
So why create competing strategies and competing funds to do the same thing when one product or one scheme could achieve the same thing?
If you look at it, it's a quasi debt kind of a product where you get return somewhere between debt and equity.
It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
There are a few brands that reach such legendary status that they become synonymous with the product category that they represent. Take Xerox, or Scooty, or even Bisleri. Parag Parikh FlexiCap Fund may not have reached those hallowed heights, but it's done pretty well. It is a household name with assets under management of over 1 lakh crore rupees as of the end of May, which makes it the largest actively managed mutual fund scheme in India. And by the way, it hasn't taken very long for them to reach this mark. In August of 2022, they were at 25,000 crore rupees. That grew to 50,000 crore rupees in May 2023. And they've doubled from that point in just over a year. What's the philosophy that they began with? Has that changed at all? And what opportunities do they see right now? Who better to answer those questions and more than the fund managers at PPFAS Mutual Fund? On Moneywise today, I'm joined by Rajeev Thakkar, who's the CIO and Director, Raunak Onkar, who's the Fund Manager and Research Head, and Raj Mehta, Executive Vice President and Fund Manager. Gentlemen, thank you so much. It's a privilege. So let me ask that first question. I know it hasn't changed, but can you tell me the philosophy that you began with? Two of you were there from inception. You joined in 2016. Correct?
I joined as a fund manager in 2016, but I have been with them since 2012.
Since inception.
Yeah,
okay.
since inception.
So, but tell me about the philosophy that you cultivated at that point. What was genesis and how it has moved?
The genesis was simple. What would be a mutual fund scheme that we would be excited to put our money in and that we would confidently be able to recommend to our family and friends? That was the starting point. And we said, we'll keep it very, very simple. One equity fund where all our ideas go into that fund. So across sectors, across market cap, and across geography, that was the thought process behind it. So it started that way, it continued to be that. Minor tweaks along the way. Primarily, the leeway to invest overseas has been a bit hampered, but otherwise, more or less the same. We haven't cluttered the offering too much. One of the reasons why the asset size looks large for us is we have very limited number of offerings. In other fund houses, given that they have many schemes, the assets get split over a number of schemes. In our case, it's concentrated in this scheme.
But it was a considered call, and I think having looked at the mutual fund industry for some time, Raunak, maybe you can talk about this. A lot of investors face the paradox of choice, which is that given that there are so many schemes, one particular category has over 200 schemes in it, and highly concentrated at that. The decision to have one scheme has worked for you because it's recognizable. But do you think that it is at all restrictive? Or do you think that the blank slate that is available to you allows you to do whatever you need to do?
That's exactly right, Alex. The scheme can go anywhere. It can invest in any market cap company. It can go even globally, which was curtailed, like Rajeev said, because of the RBI limits. But it was the mandate since the beginning that wherever you see value, whichever geography you see value, can be whichever asset class. Sometimes you might also want to sit on cash because there is no value to invest in. All those things could be done in one single fund. So why create competing strategies and competing funds to do the same thing when one product or one scheme could achieve the same thing? And that flexibility, which also is in the name FlexiCap Fund, allows you to do all of those things within one scheme. So the size is representative of all of these things working out in our favor to that extent.
Okay. You take care of debt There is a considerable amount of debt right now in the Flexi Cap Fund. I will talk about that strategy as well. But at last count, about 11%, if I'm not mistaken, in certificates of deposit plus CPs. How do you judge debt strategy with regard to this particular scheme? Is it always in money market instruments, or do you at any point move beyond that and play duration?
Yeah, so it's mainly in money market securities. The intention of deploying in money market securities is that at any point in time, if we find opportunities on the equity side, we can move from them easily. Liquidity is paramount when you are investing in debt securities in an equity fund. So that's the thesis behind it. So we have about 24-25% cash as on the month end. And roughly half of it is in money market securities, half of it is in overnight money, and some of it is also in arbitrage positions. So
yes,
it's like
about
managing a
2.5%.
treasury book across various asset classes, and depending on the spreads and the yields available, we keep shifting it.
Yeah. In the note in the fact sheet, it's written that you don't get swayed by macro trends. And you are more focused on individual companies, and as you see the opportunity, you will deploy. This has been the stated message for a very long time, since the inception, I would think, right? But having said that, there are people out there that say, especially when the markets are going up, that you're losing an opportunity and you're not going as fast as you could go. How do you respond to that?
So we have said this in our unit holders meeting, and I'll repeat that. If you are going from Mumbai to Pune, is your objective to drive the fastest that you can? And will you drive at the same speed on expressway when roads are flat? And will you drive at the same speed when you are crossing the ghats? And will you drive at the same speed when there's a red light and a traffic signal and when pedestrians are crossing? Obviously, the answer is no. What matters to us is protecting downside. That is one. Second is compounding at a reasonable rate over the long periods of time. And we look at performance over a cycle, typically 5 to 7 years. We are not trying to beat the index or any other person on a month-to-month.
But you managed to do that nonetheless. It's
Sometimes it happens, sometimes it does not. But we would be happy if people achieve their financial goals. Like if you and I were setting out for Pune from Mumbai, and if you reach 10 minutes earlier than me, so be it. Like, as long as I had a pleasurable journey and I drove safely, that's all that matters. And maybe I would take a coffee break in between if I feel like it. So it's not about reaching the first.
I think
all
it's
the
a
time.
great analogy, because if you've tested it and if you've driven long enough, you will realize that accelerating sharply is counterproductive. If you drive at a steady state, chances are that you might maybe reach 30 seconds after the other person who's been driving very fast. But having said that, I do want to ask about the equity strategy with regard to international, because that was a USP for your scheme. A lot of people decided to do that because it offered the blend of domestic plus international. Has that caused you to shift strategy in the way that you pick stocks domestically as well? Have you had to move beyond the bounds that you would normally go, that you started with in 2012?
So not really. So the way we organize our research efforts is sectorally. All the analysts in our team get a sector or a few sectors each, and they do deep dive into all the companies globally listed.
Yeah.
So our goal has been to look at companies not just in India, but also North America, developed Europe, developed Asia. These are the primary areas where we feel like there are good companies available. And within that, for example, an auto person will track all auto companies globally. A tech person will track all tech companies globally. So you also not only build a business model understanding and differentiation as to how these companies operate globally, but you also get a valuation sense as to how much the market is willing to pay for the same opportunity in India versus globally. So to give an example, some of the consumer companies have never made it to a portfolio because the valuations have been very, very high, except for a few here and there in between. But if you see their parent companies globally, usually trade at a much reasonable multiple and have a much more diversified revenue and cash flow base. That's a good opportunity to invest because you have the opportunity through the fund to invest in. If you look at some unique companies like Google or Meta or Amazon, which we have in the portfolio, which are impossible to find in the local listed market at that same scale and same cash flow profile and the same quality of management as well.
Speaking about the strategy to deploy cash, right? I do want to ask you to highlight, any one of you can take this, when you have been least cash, when you've been most deployed, and what instances that has taken place. Maybe explain the context as well, and talk about where we stand right now and juxtapose the two if we can.
Sure.
Yeah.
So March 2020 month end, we were maybe 2-3% in cash, so almost fully deployed,
right,
almost to the last rupee. Some money is there to meet inflows, outflows, etc. At peak, we have been as high as 30%. This was late 2017, early 2018 kind of thing. So it's basically what opportunities are coming our way. In end Feb 2020, we were about 12-13% in cash. So within a month, we were able to deploy 10%. So it's not been so much about size of the AUM or any macro view or waiting for any event to happen. It's just based on our research, the pitches that get made, the quarterly earnings that come out, corporate developments. If we find something interesting, we go out and deploy, and cash is the residual.
Yeah. And you've not churned very much at all. I was looking at the turnover ratios at 14% or thereabouts, and some of your peers at 100+%. And so that essentially drives home the point that that is the case. But I do want to ask about the debt strategy. I know we talked about it, but if I'm not mistaken, at where it stands right now, of course, cash has been high, as you pointed out, 30%. But have you had money market instruments in the past?
Yeah, we have had at some point in time. So as Rajeev pointed out, in late 2017 or early 2018, when we were at about 30% cash, we had some positions in T-bills, G-Secs also at that point in time. Okay. So it's not the first time that we are having this.
Okay. There is an introduction of real estate investment trusts that I saw in the May disclosure. Can you take me through? It's a small amount, 0.35% or thereabouts, and 3 REITs. But what was the thinking?
Yeah, sure. So the thinking behind that was that instead of keeping it in money market instruments or cash positions, these REITs were available at around 5.5 to 6.5% distribution yield, depending on the REIT that you are looking at. And given that over the next 12 to 24 months, these REITs are going through a period where the occupancy levels will go up, the rent escalations will keep coming in, and hence the distribution yields will improve over a period of time. Also, what happens is that in most of these REITs, you also get capital appreciation through the NAV appreciation that happens. So if you look at it, it's a quasi-debt kind of a product where you get return somewhere between debt and equity. So we thought that it's a good proxy to cash right now, and just building up small positions over there. So we have had REITs in our hybrid funds, but this is the first time that we are having it in our flexi cap fund.
Interesting. And so is it likely to stay very small, or you might just replace some of your money, considering that you've seen interest rates at the policy level be cut, and one would assume that will pan out for money market instruments as well. You would get higher yields on REITs, so therefore you could have a higher position?
Yeah, so we'll keep evaluating it and we'll keep building it over a period of time. So liquidity is also not that great in most of these REITs. So you need to build it over a period of time, and depending on where the prices are, we'll take a call eventually.
Yeah, I forgot about the need that you have for deployment of that 24% very quickly, or not now 24%, but the cash or cash equivalents very quickly. And so in all probability that in the flexi cap fund, it will likely be in highly liquid instruments, right? It will continue to do so.
Yeah, so you have to manage liquidity, you have to manage return, you have to be mindful of the risks. It's a balance of all the three things. Primarily, it's an equity fund.
Yes.
So our first preference would be to deploy in equity, given opportunities. While we are waiting for that, we are open to other interesting areas, arbitrage being one, money market instruments being the other one, REITs or possibly InvITs. anything could be possible.
Let me ask the research head. When we're talking about the way that you evaluate companies, of course you have your filters and you are bottom up, and so therefore you'll notice that I have not asked you any macro questions. But when you look at potential candidates, what is your process like? And you mentioned that the research team gets in touch, but when you do sit down and you discuss ideas, what are the key tick marks that need to be there?
So the key points are, I think, an oversimplification, but I would like to repeat them nevertheless. One is to look at the people who are running the company. Are they trustworthy? Have they been running the business well? Do they have the competence to do that job that they are offered as a CEO or promoters of the business? And are their incentives aligned to you as minority shareholders in the longer run? It's very important to find the quantitative as well as qualitative aspects of this particular aspect of the filter that we have for people running the business. The other most important filter is the quality of the business itself. So one might have a great quality of promoter or great management, but if the quality of business is not worthy in terms of having a good runway ahead of them, or even earning sustainable profits or return on capital over a long period of time, cyclically adjusted, or even having the capability to think or innovate in that category and outbeat the competition, create a moat around that business in some way, make it harder for people to compete with them. If that is not the quality of the business, then it's very hard to find a sustainable competitive advantage, or even owning something for the long term then becomes very hard. And lastly, all these things have to tie in together with the price that you pay for this opportunity, and that's where most of the debate usually happens. Like, unequivocally everybody agrees on the quality of people and the quality of business. The debate happens usually on price. As somebody, now valuations have crept up, do you want to pay more? Why should you not pay more? Why should you pay more? What are the alternative opportunities that you can consider? And given that we invest globally, and like I said, even little bit of the portion right now, about 10% is still global, we can churn among those stocks. So it's usually is, can you find a better alternative to what you already own? If not, what you already own might be the best thing you can continue to own.
Okay, I know that you're a student of Buffett, you're a follower of some of his principles. So let me ask you this. He has had exceptions to his rules where he's gone out and paid more than he thinks is appropriate in certain situations. I'm talking about Coca-Cola, I'm talking about maybe a few other situations where he's bought maybe what other people might have considered expensive from his lens kind of businesses, but he thought that it was worth it. When do you make that exception? What do you need to see? And the reason I'm asking this is that where we stand right now, so much is already discovered, and information asymmetry is dissipating as we speak. So how do you make those exceptions?
So I don't think Buffett has made any exception at any point in time. What you are referring to is his shift from very, very statistically cheap companies to companies which had great characteristics. So he's, like most things, he's put it in a wonderful sentence.
Yes.
So he said, time is the friend of the wonderful business and enemy of the mediocre.
Yes.
So again, in another sentence, he's said that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Yeah. So that's so. In his early part of her career, he was looking at what were called nets, where he would buy cigar butt companies, where he would buy companies trading for net working capital and the like. Coca-Cola that you mentioned was not of that kind, but something which was a duopoly, Coke and Pepsi, and where he saw a long runway and global expansion and various things. So he paid up more as compared to what he was paying for the cigar butts. That's all that he has done. But he's never overpaid in that sense. In today's time, one, definitely, if you have a longer term time horizon than others, and where the business has a moat and sustaining power, then you can have a differentiated view, where if other people are taking a 1 or 2 year view, you can say that, okay, this business will last longer. However, that decision is not to be made lightly. a lot of things that were considered moats no longer are.
Yes.
So at one point in time, if you were a consumer goods company, your distribution would be considered a moat. And access to huge advertising budgets where you could advertise on television and outdoor media and newspapers, that would be considered a moat. With internet, with third-party logistics, direct-to-consumer brands have been giving a tough time to the legacy FMCG players. So that is no longer a moat. Let's say a sector like paints, neatly divided among 3 players, and a 4th player comes in aggressively. So what was considered to be a moat does not seem to be that strong any longer.
How do these outcomes usually come about if you're arguing about price in the team who has the final call?
It's a debate. It's the debate is the fun part.
Yeah.
So not everybody has the same perspective, experience, or understanding of the cycle, right? So you try and probe people as to why their emphasis on buying today is greater. So people might not have considered cyclicalities of the business or uncertainties or concentration of customers. So I'll give my example as well. When I was younger, I would underweigh the concentration of customer risk or vendor risk. But as I've grown a little older, I've realized I've seen some stocks failing. I realized, now it's important to have a diversified customer base. We should have a counter-cyclical business model as well. So some of these things matter a lot more, and it's easier to debate them when you have seen those cycles rather than not having seen those cycles yourself.
Okay. Where we stand right now, in June of 2025, as you said, there are so many narratives that have been building, and projections in terms of earnings growth. Various theses are being propounded. I want to understand how you're thinking of where we stand right now for the companies that you have in your portfolio. What your own judgment and estimations are for the earnings growth. You've increased your weightage in a few stocks. You've sold a couple. I don't want to get into absolute nitty-gritties, but give me a sense of where you see earnings growth in the foreseeable future.
So it will vary from company to company, sector to sector.
Yeah.
And again, valuations will take those things into account. What we are essentially looking for is, we are looking for profitable growth. In a lot of cases, people just get driven by overall sector volume growth or volume growth in a particular company. Many a times profitability does not follow. Again, taking you back many years ago, Bajaj Auto was a two-wheeler company largely into scooters, and they had a waiting period for their Bajaj Chetak scooters, 5 years. It wasn't a very high quality product, but it was a very profitable franchise for them. Now, Honda came in through a joint venture, and other Suzuki came in through a joint venture. Competition increased, and they had a tough time. So, where the pricing power is moving, what is the competitive intensity, what will be the impact on margins, those are the things that we are watchful of, and not just the next 12-month volume growth for either the sector or the company. I think a lot of mistakes will probably get made on this account in the current market.
Apologies, I had to look at my notes because I was curious about something that I read on your website. Of course, you invest in your own fund, but I read the Hammurabi Code. And I think that's quite an interesting thing because it got me. I couldn't remember the name, so I had to look at the notes. But can you take my viewers through that? What does it mean for you? You say that you're motivated by that, or you're driven by that.
So, in the olden times, it was a very extreme form where life and limb was at risk. We are risking only our family's investments. So, Hammurabi Code was, if you build something, you had to take the risk of, let's say you built a bridge, then you had to stand under the bridge when something crossed, or if you build a house, you had to be the first one to enter so that it does not collapse or something like that. So you were effectively guaranteeing via your own personal safety that what I've built is solid and of a high quality. In our case, we are investing our family's net worth or bulk of our savings and investments into our own schemes. So
And that is true for most employees of the mutual fund, is it not? And a lot, I've heard a lot of people are doing well. They're making a lot of crorepati getting made at PPFAS.
It was not mandatory at one point to disclose all of this information, that how much individual investors own from the employee pool or even the directors or promoter family. But we have been disclosing it on the website right since day one.
Yeah.
And in the skin in the game section of our website. And now across all schemes, we can see individual names, how much units everybody owns. And it goes all the way down, even for the receptionist, even for the office boys who have never probably had a chance to save money in that format. It's encouraging to see that they also trust us with their own money.
I'm glad, and I'm glad to hear that. Let's end this program with a message, and I like to do that with everybody that I call on to my shows who manages people's money, because ultimately I'm only a conduit. So each one of you can give a message. Rajeev, we'll start with you.
I think it's important to keep the end goal in mind. It's actually a very, very boring activity, investing. It's not for excitement. I think people get too much drawn into outdoing their neighbor or beating the index or buying the hottest fund. It's about meeting your retirement goals, education goals, or whatever personal financial goals that are there. It's actually a very boring activity.
Right?
I think the boring part is about investing, but the exciting part is if you have curiosity to learn about the world, it's a great opportunity to research different companies, different sectors, peek behind the curtain and see what's happening in a particular company, study these value chains, and then bring it back to the portfolio when the time is right. I think that's a great way to look at investing as well.
Raj, I've left you for the last one.
Yeah, so focus on your asset allocation. Last few years have been very good for equities, because of which the portfolios are equity heavy now. So focus on the asset allocation, temper your return expectations, and widen your time horizons. Yeah, that's
Fantastic. Gentlemen, it's been an absolute pleasure having you on the show. Thank you so much for taking the time.
Thank you for
the
inviting us.
It's been an absolute pleasure having this conversation. Let us know what you think in the comment section, and do stay tuned. This is NDTV Profit.